Hey, Victor, welcome back to another episode of the Beckonomics podcast. I think we have a really interesting episode today. We're going to take a look at the narrow market participation that we've seen in the S&P and the broad indices over the past really year and a half since the beginning of 2023, and talk about the expectations for the future and the broadening out in that performance that we're really expecting. And just a reminder, if you're enjoying this content, remember to give us a subscribe or a follow on all of the social media platforms.
Yeah, Hunter, I think this is a really interesting topic. We've seen over the last year and a half or so, like you said, since beginning of 2023, really, we've had very concentrated market performance. And you may not notice if you're just watching the headline indices. The S&P 500's really rallied significantly, but that's just because of how much market weight is in those mega cap tech companies. So we've talked about before the Magnificent Seven. That was really a big phenomenon in 2023. Some of those companies have continued to perform really well in 2024, but that's really where the concentration of that market performance has been. Your Apple, Amazon, Meta, Google, Nvidia, Microsoft. Those companies have really been pushing the market forward. And as we're going to talk through this episode, we have reason to believe that exceptionalism isn't necessarily going to end, but we believe that the market breadth is going to expand to more of those mid-cap companies, some smaller cap companies, ones that haven't really been representing the S&P 500 so far, but could help push the index higher on a go-forward basis over the next year or so, really as rates start to drop. I mean, just to give everyone kind of an example of how concentrated it's been, the S&P 100 has done about, call it almost 60% from the beginning of 2023. And that's the market cap weighted top 100 companies in the S&P 500, about 60%. Now the top 500 companies, S&P 500, has done about 45% since the beginning of 2023. So you went from 60 to 45. Now the equal weight S&P. So if you're going to equal weight all of the companies in the S&P 500, instead of doing it by the capitalization, by the size of the company, just everyone is equal, that has only returned about 18% since the beginning of 2023. And then if you extend yourself out to the Russell 2000, so call it the roughly 3,000, a little bit more than that, companies trading actively on public exchanges, the 2,000 smallest companies outside of the top 1,000, those have only returned about 16.5%. So kind of as you go down that market capitalization scale, you've seen lower and lower returns. And I think that's really interesting because there used to be this whole phenomenon about investing in small cap exceptionalism, and that's where all the stock pickers were in the early 2000s. But we've really seen the opposite of that now. And so I kind of like to go through a little bit of how do we get to that point? You know, what is it about these companies that has created this dynamic? And then what's changing on a go-forward basis that's going to help broaden out that market rally?
Yeah, and so there's been a lot that's happened in the past year and a half that's really led to this concentration in performance. First off, coming out of COVID, you had a couple years of good returns. But in 2023, you really had the Fed rate hiking cycle and this flight to safety. So people found safety in these mega cap companies who were growing earnings, had plenty of cash on their balance sheets, really strong balance sheets in the case of, someone like Apple, who just has more cash than they know what to do with. Debt's not a concern. They're not really suffering under higher interest rates because they have so much cash flow and such strong cash flows, and such low relative debt levels. And so there's this big flight towards safety, coupled with what we saw in the AI mania, really, that's been the past year and a half of huge growth in earnings for companies like Nvidia and a lot of your other large tech companies who are either investing in this or set like Nvidia selling the actual products required to run all of these AI systems. So you have these two big forces going on, and all of your players are in that really top 50 companies in the S&P space. And so that's where so much of this was concentrated. And so there's a flight towards that over that past year and a half time period.
Right. And that's an excellent point. You mentioned interest rates not impacting those bigger companies. And so I like that you mentioned the first half of that dynamic, why those big companies perform so well. And then to mention why the mid cap, smaller cap companies didn't quite perform as well goes back to those interest rates. They have higher debt levels traditionally because they are seeking financing to propel future growth. So whenever you're investing in your company, it's still small. You may not quite be profitable yet. If you're in the S&P 500, you have to have positive earnings. So those companies are typically profitable unless they've gone into profitability and come back from it. But in order to propel those earnings forward to continue to grow those, you have to invest in your company. And a lot of that's done via debt markets. And especially when you're talking about the pre-Fed rate hiking cycle, I mean, debt was so cheap, it made sense for companies to lay on debt because they're looking at even junk debt was going for, low single digit interest rates. And so when you can finance your activity at that, it's a no-brainer. But what was coming to fruition is as the Fed started hiking rates, all the investors are looking at these companies seeing, hey, this company that financed its debt at 4%, on a look back basis, going forward, they're going to be refinancing at 6, 7, 8%. And that's not looking so positive anymore. That interest burden, that debt burden becomes much more impactful to the bottom line. And so investors saw that and they were a little bit scared away from those companies, and for good reason, because it fundamentally creates lower value in that company. And so I think that's a really interesting dynamic, looking at the combination of why the big players perform so well and then why the smaller players have lagged behind.
Yeah, a whole bunch of different factors going on, all pushing people towards those bigger cap companies. And so looking forward, so the rate hiking cycle really hurt these small mid-cap companies that are a little more debt focused, but can also be pretty fast growing and good companies despite that. Looking forward to rate cutting cycle, how do we expect that to change? And a little teaser here, probably a lot of the inverse of that. These companies are going to be more attractive because debt isn't so much of an issue, but take us through that, Victor.
Yeah. So as we approach this rate cutting cycle, I think it's going to be beneficial for those companies. I already kind of went through the dynamic of why higher rates hurt them. For the opposite reason, lower rates are going to make those companies look a little bit more attractive. We're going to do a follow-up episode. We've talked about the Fed a lot, which is mostly because the market has been so Fed driven over the last year and a half, 3 years or so. And, but we expect a couple of rate cuts this year in 2024, and then probably another percentage of rate cuts, maybe more in 2025, and then more going into 2026. So over this next, on a forward-looking basis, we're going to get, a couple percentage points of rate cuts over the next couple of years. And that's going to help those companies. And then the other part of that is when you're looking at these smaller companies that are growing, a lot of the way investors put a price on these companies is they're not looking at how much money they're making today because they may not be profitable. They're looking at how much money they're making in the future. And in order to turn that into today's dollars, how much are those future earnings worth in today's dollars? Because that's the price that you're paying today. Well, those have to be discounted back via interest rates. And so as interest rates drop, you can warrant a higher multiple on those companies. And so that dynamic creates higher prices today for those future dollars because your opportunity cost is lower. Because when you have the option of, hey, I'm going to invest in a government treasury yielding 5%, or I'm going to invest in this company that has these future earnings. Well, you're comparing the two, right? So in order to make those present dollars make sense, we discount those back via an interest rate. And as interest rates drop, it creates a higher multiple for those companies today, and people are willing to pay more.
And speaking of those future earnings, that growth has been largely concentrated in those bigger companies at the top of the S&P 500. Well, currently estimates are more broadening out. We're expecting a lot more earnings growth in those smaller companies, which will help them on a discounted basis, valuation basis. But there's also the dynamic of, even despite the earnings growth that we've seen in the large companies, the price to earnings ratio, how the valuation of these companies, how relatively expensive those future earnings are, has grown greater than the smaller mid cap companies. Like the S&P 500 is currently sitting at a forward price to earnings multiple about 22 and a half times, where you have your Russell 1000 sitting a lot closer to 17. And so those earnings are not only cheaper on a valuation basis, but they're also starting to pick up some more. So being, what we describe as kind of GARP investors in a lot of senses, growth at a reasonable price, those look a lot more attractive from multiple different points of view.
Right. Kind of going back to what I said before. Yeah. The multiples hadn't expanded as much for those smaller cap companies because people were not willing to pay as much for each future dollar of earnings. And so, but they were for those mega cap companies. And as you mentioned, you had earnings growth exceptionalism in those bigger companies alongside that multiple expansion. So that's really the combination of what creates a stock price, what creates a value for a company, is the combination of what are the expectations for future earnings and how much are investors willing to pay for those future earnings. So you've got the future earnings point, and then you've got the multiple being your price to earnings ratio. How many times over am I going to pay for those future earnings? And so whenever you feel more sure about those future earnings, you're going to pay more than one of these smaller companies where you're not so sure in this higher interest rate, kind of precarious economic environment. We didn't even mention the fact that so many economists believe that a recession was coming down the pipe at some point. We haven't seen that. Luckily, doesn't look like that's going to materialize, but something that investors were apprehensive of. But now those things are unwinding. And so you're going to see people more comfortable investing in these smaller companies because they're going to start feeling better about those future cash flows. And so I kind of want to lead that into the parts of the economy that we are looking at now. Obviously, anything interest rate sensitive is going to benefit from rate cuts. We're going to continue to talk about that throughout podcasts and throughout episodes that we conduct. But as far as more industry or sector specific, you'll have REITs, especially because those are higher dividend yielding, treated a little bit more like a bond or a fixed income option. Those are going to benefit. They've kind of lagged the market. Real estate has been really tight because of interest rates. And I think that as we talk through these sectors, it's important to know that it's not a sector-wide phenomenon in all of these things. You still have to be very cognizant of where a company is sitting within that sector because certain companies have higher debt burdens. They may not be as profitable. You have to do both bottom up and top down kind of macro analysis in order to figure out the winners in this next cycle. But as we see that broadening out, I think it's good to go through these sectors of the market. Like I said, real estate and REITs, utility companies, because they're also higher dividend yielding. And then, as I mentioned, kind of your fixed income. But do you have some other sectors that you're kind of looking at that have kind of lagged behind over the last year and a half, but, have potential to do well moving forward?
Yeah. So broadly, information technology and communications has been where the top of the S&P has been concentrated. So a lot of the other ones that we're looking at, talking about healthcare, industrials, materials, a lot of different macro forces going on with all of those. But industrials, materials, there's a ton of government spending going on right now in the form of the CHIPS Act, a form of infrastructure spending, of data center build out for those AI models and that whole AI shift. There's so much of that going on that there's a huge demand for, these industrials companies, and most of those aren't in the top 100 companies. They're the broader part of the S&P, they're the Russell 1000, and a lot in the Russell 2000. So they're, the rest of the market really, that are supplying all of these necessary components and just raw building materials that go into either the components themselves or all of these new infrastructure projects required to support this investment. So looking there, as well as, energy companies and, like I mentioned, healthcare for their own issues, energy and utilities, both are going to benefit from the increased demand for electricity that we're seeing from all of these AI data center infrastructure projects, because the grid can't support them. These things are very power hungry. And, a lot of companies are looking at building whole nuclear reactors just to power one data center location. That's how incredibly power hungry these are. And so as all of that gets built out, as there's so much more demand for all of that, these utilities, which were once basically a fixed income, they pay you a dividend. They don't really grow very much because their growth is capped by regulation as far as what they can charge people. But now there's so much more demand that it's not even it's not a price per kilowatt issue anymore, like it was for the longest time. Now it's, we get to sell twice as many kilowatt hours. So looking at that for, those specific reasons, but there's a lot of opportunity out there in the marketplace right now.
Yeah, I love that you bring up these trends in the economy, because it's felt so Fed driven over the last couple of years that it's like the only thing people care about is the Fed and the next inflation reading and the next interest rate cut or hike. And it's been such a high up macro, top down kind of impact on the markets that some of these dynamics that you're talking about, healthcare, having an aging population that's spending more for healthcare providers, like you said, higher energy consumption via data centers and growing electrical needs, the infrastructure spending that's creating more demand for your materials, for your construction companies. These have all kind of been working beneath the surface. And because of this, Fed-driven kind of market, they haven't really turned out the way that you would maybe expect under more normal circumstances. But I love getting to this kind of economic market forces investing period where you can look at these underlying companies and say, hey, who's going to benefit from this and where are we going market forward? We don't have to pay attention to interest rates quite as much as we did historically. It's a new kind of market paradigm that we're working under.
Yeah, I think to that point, it's a really great time for active investing because there's so much going on, and you can look a little bit more detailed, like you've mentioned before, to the bottom-up analysis that wasn't so necessary given the top-down huge macro overhang of the Fed. Coupled with that, you still have about 40% of the Russell 2000 that's not profitable. So a lot of that, you can't just broadly go into small caps like this. Like it may sound like we list all of these sectors that we think are going to do well. Well, that's a lot of the market, but it still doesn't do you much good to just go in broadly when almost half these companies aren't even profitable to begin with and probably won't be for years to come.
Right. And we still are in this semi-precarious economic situation. So you really, to your point, I mean, you want to be active picking the companies that are going to benefit from these trends, but still have the solid fundamentals that maybe the market wasn't paying attention to before, but now feels comfortable on a go-forward basis investing in. I think that's really going to be beneficial. I think also a major point is we talked about kind of the benefits and the movement towards these small and mid-cap companies. I still think that these larger caps, especially the AI companies, are going to perform well, but the disparity in returns, I think, could shift over these next, call it 18 months. And I think that's going to be an interesting dynamic to follow.
Yeah, I agree. And I have to say personally, I think it's a lot more fun of a market environment to be an asset allocator in because you get to flex those macro muscles, but also those micro muscles. As the micro economy matters a whole lot more now than it has for the past year and a half.
Definitely. Well, only time will tell if this really comes to pass, but it's looking more and more like this will be the situation going forward. And as you mentioned, I'm excited to be investing in the midst of it.
Great. Thanks, Victor.